Second is to protect themselves from adverse price reactions. Oftentimes, hedgers have to deal with many different elements, such as weather, such as crop shortages or new tariffs being put in place. And so there's a lot of what we call fundamental information that can affect their day-to-day purchases. So they have to be very careful in making sure that they're not caught unaware of a huge spike in the price of cocoa or a huge run in interest rates. Lastly, they simply want to be profitable in the cash market. Futures is not an investment for them. In fact, the goal of the futures contracts that they hold is actually to lose money. They hope that the futures contracts don't come to fruition because the futures investments are a small percentage of their portfolio. They would prefer the cash market to actually be where they make their profits. Second, we look at the speculators. Well, first we'll go to the example of where the hedge trade is. Farmer in Kansas City decides that is planting corn in April and intending to sell this same corn in November. He's worried that there's going to be a huge drop in the price of corn. There may be unexpected rainfall, and so many people are going to be bringing corn to the market. So he doesn't want to be caught unaware. So what he does is he estimates how much corn he'll harvest, and then he'll go out and short the November corn futures contract to protect himself. And again, it's a small investment for him, maybe 2 to 5% of the total value of his crop, but it's an easy way to protect himself from a huge glut in futures. Speculators. There are many types of speculators. Primarily, though, there are money managers, individuals, and some banks, brokerage houses, and currency traders. Now, for speculators, there's only one goal, and that is to profit from the price discrepancy. Sometimes through arbitrage, which is buying and selling simultaneous contracts on different exchanges, but most of the time just simply trying to catch the little fluctuations that happen in the fundamental information that goes on. They provide the liquidity that the market needs. Without speculators, there is no futures market. Speculators are a necessity. So it's also important that the speculators understand how futures operate and how they operate for them so they can trade it effectively and provide the liquidity. Speculators who know what's going on are the best type of speculators because they come back. And you have to remember, this is reminiscent of the old-time English merchant traders, where we talked about before in the UK, the Royal Exchange allowed people to trade in coffee houses. Well, not everybody who traded in the coffee houses were actually taking delivery of these contracts. They're providing the liquidity and setting the price and the tone for these contracts. So you have a strong history as a speculator. An example of a speculative trade. You have a currency trader in August who believes that the European Union has to weaken the euro currency for the Christmas season exports. So he's trying to base his decisions on fundamental information. Whether or not they're true is unimportant, but he's coming in with some knowledge. So he looks at his account balance to determine how much he wants to commit to this particular trade. And he also looks for the futures contract that is closest to the Christmas time. And based on his assessment, he decides to short the December euro futures contract. This thought process is very typical of futures traders. It's important that as speculators, we take our time to decide what kind of contracts we're going to trade. Now we'll go into historical futures anecdotes. These anecdotes are very important because many of these stories have colored the way people look at futures, and they'll give you insight in how futures trades. Japanese rice futures. Many stock traders, and here at pristine.com, I know this for a fact, I've attended several seminars, use candlestick trading as a way to determine accumulation and distribution and to get an idea how trading is going for a particular stock. Well, the funny thing is candlestick trading actually originated and was developed for rice futures. The Dojima Rice Exchange was formally institutionalized in the late 1600s. It was a rice exchange that was necessary for Japan at the time because more and more people were coming to the big city to trade rice. At the time, they had over 1,300 rice dealers occupying seats, trading in rice contracts. And out of this developed the candlestick trading method, in which people wanted to know who was buying what and how they were developing rice in different regions. And it was very interesting that futures trading in rice sets the tone for today. Now, the warehouse holders sold receipts against the stored rice, and these receipts were known as rice tickets. And many people throughout Japan use these rice tickets as a form of currency so they can make profits or to protect themselves, because they knew that the rice tickets were honored everywhere throughout Japan. There would be no worries that they would be able to buy goods with them. And as I spoke before, there's always a little discrepancy in the number of contracts traded versus the actual available goods on hand. Well, in 1749, as the rice futures started to develop, there became over 110,000 rice bales that were traded in the open rice ticket market, while actually there's only 30,000 bales of rice which existed in the warehouses. Very interesting how credit and money was developed from such a small cache of goods. And the funny thing is, the rice futures at the time was traded identical to the way current futures markets are being traded. And so it's a little bit of history repeating itself with today's futures markets. So it was very organized and very well developed. So to this day we use the same model. Now we can look at the tulip bulb mania. Many people have heard of how tulip bulbs have affected the investment arena back in 15th century and 16th century Holland. But they don't understand to what degree this affected the markets in Holland and how it actually ruined their economy from commodity mania. The word bourse is actually derived from the tulip mania tulip mania era. And in the tulip mania era, a family called the Van Bourse family allowed people, middle-class people, to come into their homes and trade tulips one for one. And is a little bit of history. It's kind of funny that to this day, that's a leftover from the tulip mania, although the tulips are no longer traded on any type of exchange. How tulips were introduced was in 1559, Conrad Gessner brought the tulips from Turkey to Holland and Germany. They'd never seen these beautiful, rare flowers before, and so the aristocrats decided to buy into these beautiful flowers. Well, over time, peoples began to cultivate tulips domestically in Holland, and so the value of the actual tulips began to become diminished. But at the height of tulip mania, rare tulips went for as high as $20,000 per tulip. In fact, one interesting example is one single bulb was sold for 4 tons of wheat, 8 tons of rye, 1 bed, 4 oxen, 8 pigs, 12 sheep, a suit of clothing, 2 wine barrels, 4 tons of beer, 2 tons of butter, 1,000 pounds of cheese, and 1 silver cup, all for 1 tulip bulb. Now, that seems excessive. And at the time, many people felt the same way. What was driving and fueling the industry for tulip bulb mania was that the banks were willing to lend on tulip bulb values. And as the tulip bulbs began to lose value, fewer and fewer banks began to lend on them. And it got to the point where the Holland government had to actually mandate rules and laws to eliminate debt from people who had spent as much as what I had mentioned before for tulips. Very interesting time, and we see a repeat of this from time and time again, from the dot-com bubble and even in futures trading, this excessive need to buy.